Hello, Steve Lentz here with Discover Options, and welcome to this edition of the Market Reports. This is for Friday, February 3rd, getting ready for Monday, February 6th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, we have two reports for you today. For those of you advanced options traders that trade condors and butterflies, we like to help you time the entry of those and understand what season we're in, if it's a season that's better than normal or less than ideal. All right. Now, also we have a report for those of you who are more statistically minded. We have the directional likelihood report as well. What I'm going to do is go to the results of both reports. Okay, for those of you veterans, and then we're going to adjourn and get into the weeds for those of you just starting out and you want to understand the methodology. Okay, now before we get to that, just let you know you could certainly subscribe by clicking on the subscribe button, and also for those of you new, we have a free ebook for you, Simple Steps to Options Trading Success. You can click on the link and download the information, and we'll get that to you, co-authored by Jim Graham and myself. All right, let's go to the current market condition. Fairly unusual in the sense that the market is above its 50-day moving average. We had a downswing day on Thursday and then an upswing day on Friday. You know, Thursday was lower low, lower high, and then a higher low and a higher high. All right, downswing then upswing, all while the stochastic then is now curling up. It's trending above the 53 stochastic is trending above its 3-day average, and then it is between 50 and 90. All right, so all that makes for a unique market condition that has occurred roughly 60 times since Jan of 2000. I know it's hard to believe, and you can see 3 additional times in the past where it's happened there, but there it is. Let's go to the Condor and Butterfly timing report, and I'm just going to go straight to the narrative right in the middle of the page. Since January of 2000, there have been over 4,200 daily closes of the SPX. Of those 4,200, actually 4,276, 64.9% have been favorable for selling premium like condors and butters, where the actual 21 bar movement was less than the SIBO SKEW adjusted implied movement. Okay, so also during that time, the current condition detailed, what I just showed you, has occurred 59 times. That includes successive occasions. Of those occurrences, 61% of the bars have been similarly favorable for premium selling. This implies a premium selling edge of negative 3.9 if you take 61% minus the baseline of 64.9. Okay, of all the times that this condition has occurred, slightly less, there's a slightly lower percentage of them have been favorable bars. Okay, so the benchmark number of bars for the whole market since Jan of 2000, 64.9% have been favorable. This market condition results in the past at 61%, slightly less. So keep that in mind as you do your butterfly condor report or trading, that there's just a slightly, judging from the past. Now 59 is not that much. Okay, but if you're going to lean a little way, you need to, be a little more prepared than normal, that things can go, that the market can move more than what the options are implying. All right, so slight negative edge coming to us from the timing report. Now, in terms of the market likelihood report, what we do, folks, real quick, we set volatility bands from the close, and we ask ourselves if the market's going to hit those volatility bands in the next 5, 10, and 15 days. We take the current market condition and go back and see if it's hit those bands more or less often than normal. And that's what you're seeing here. You're seeing a lot of red numbers above, some blue numbers down below. Now this is the volatility bands determined by Statistical. These numbers are the volatility bands using SKEW adjusted VIX figures, where we have a few more blue numbers, meaning that the bands are hit slightly more often. And so here you can see basically that the upper bands are hit less often, and the lower bands are altogether hit a little bit more. So if you're going to lean a direction here, you would lean it a little bit to the bearish side. That's what we're seeing here. All right, the green are the reflective of the upper bands, and the pink on the right would be reflective of the lower bands. We're going to get into the weeds there, but if you had to lean it, you would lean it slightly bearish. All right, so let's get into the weeds now and dive into the methodology. Let's go to the Condor Butterfly Timing Report. We're going to examine why you would look at this, the methodology, and we'll examine the current condition and edge level in much greater detail. Here you have an example of the market beginning to channel. And you might have thought at the time that putting on a butter or a condor might have been good, but when you run it through the algorithms that I just showed you, indeed we come up with a negative edge. Now what that meant is that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. And in this case, it indeed did take off to the downside. A cherry-picked example, admittedly, but I just wanted to show you perhaps there could be some predictability, but in any case, it lends some credence to the notion that a negative edge could be predictive. All right. Current condition I just showed you on this butterfly timing report. Here's the question on the table. Is this current condition a good one for selling option premium through range trading, butters and condors? Is the current condition a good one for selling premium? That's the question on the table. How do we answer that question? We observe first how much the market actually moves from a given close. We call that actual volatility. Then we observe what market move is predicted by the option prices. We call that the implied volatility. We then compare the two in hindsight for each bar going back, and we label each bar red or blue. Let's just take an example here. Here's an example of actual volatility. You could take a given close, you move forward in time 21 bars and ask yourself, how far did the market move from that close? Here, it clearly went down more than it went up. It went down a total of 50 points, which works out to 2.4% that we can then actually graph using an indicator. Now here's the question on the table at the same time. What market move was being implied by the option prices at the time of that close at 2076? When you run the numbers using a SKEW adjusted VIX, okay, on that downside move, 4.4%. 4.4%. Okay, and what was the actual move? 2.4. So in this case, clearly it turned out to be favorable. What we're going to do is paint the bars blue that in hindsight were favorable. We paint the bars red that in hindsight were unfavorable, meaning that the market moved more than what the SKEW adjusted VIX was saying at that time. Okay, and then the black ones on the right, well, those are 21 bars on the right. We have to wait until 21 bars have gone before we can label a bar blue or red, favorable or unfavorable. The jury's still out on those. Okay, so then we paint the bars red or blue going back, and now we can really conduct some studies. Okay, here's the studies we're going to look at. Historically, what percentage of the bars are favorable? Of the bars that match our current condition, what percentage of those in the past were historically favorable for selling premium? If there's a difference, it could represent an edge. So when we go back and look at all the 4,300 bars going back, the percentage of those that are favorable was 64.9%. Okay, 35.1 were unfavorable in hindsight. Okay, now, next step is we're going to look at those that match our current market condition, what I just laid out for you in terms of price action, moving average, and stochastics. Of those 59 or 60 going back, what percentage of those were historically favorable for selling premium? 61%. So the edge then, in this case, is negative. 61% minus the baseline of 64.9. We have a negative edge, a small negative edge of minus 3.1, okay? Now, does that mean you're going to lose money if you trade a butterfly or condor? Of course not. You have a 61% chance of it just working out fine where the market behaves itself. All right, 39% chance it won't. But normally your odds are 64.9, just a coin toss. But given this current market condition, it's a little bit worse than a coin toss. That's what we're saying here. All right. Before we get going, and so that's the conclusion of that butterfly condor report. Let's go to the next one. Before that, just make sure you know we have a fantastic options trading curriculum to get you going from an intermediate level up to an advanced really, you could be a money management level trader using our mentors to help guide you through the principles and philosophies that we have on risk management and everything. We have a couple great curriculum sets here. The equity track takes you from really beginner all the way through advanced. Futures track for the futures trader. We have an earnings curriculum and the overlay curriculum as well. So give it a look. Please give us a call if you have any questions and you want to really custom design a program for you. That'd be great. Okay, let's go to the market likelihood report at this point. We have the statistical volatility numbers here. Here's the question on the table. Since Jan of 2000, how often has this same condition occurred, the one we just went over, and what did the market do in terms of direction and volatility? What did the market do for those 59 times? Okay. Here's how we determine this. We first look at the historical distribution of price, okay, just a baseline distribution. Then we look at the distribution after a specific condition develops, like what we just encountered, where we're at right now. A potential tradable edge exists when the two are significantly different. I mean, if we know from our market condition that price is distributed bullish every time, well, then we're going to be bullish. If we look at our current market condition and, you know, every single time it went down, well, there you go. You want to be bearish. But how do we measure whether it went down or whether it went up? Okay, that's the question that we're posing here. And here's what we do at Discover Options. We measure this by observing how often price touches one standard deviation volatility bands that are placed from each bar's closing price. Okay, we're going to measure distribution. Okay, this is the historical distribution of price. We use three sets of bands, one to the, three to the upper and three to the lower, set in 5, 10, and 15-day distances. One standard deviation from the close using a 20-day statistical or historical volatility number. Now we also do another one using the VIX, but I'll get to that in a bit. These are like normally distributed. So here's an example. You could take a given close, okay, and then you have the upper 10-day band, the lower 10-day band. The question on the table is, does price go up and hit the upper band, the lower band, or does it wobble in the middle? So for this close, we want to know what happened. So let's take a look. Okay. Clearly it went up and hit the upper band. So for that given close, we make a notation in our database that it went up and hit the upper band. Okay. Now let's take a look at the next one. This close, we have an upper band set out 10 days. The lower band, did price go up and hit the upper, the lower, or did it wobble in the middle and not hit either of them? So let's take a look. Okay. It tried to hit that lower band, failed to, so it hit neither of them. So for that particular close, we report it hit neither band. And so what we do then is we measure the historical distribution from every close, recording how often price struck the upper and the lower 5, 10, and 15-day bands. And we keep these statistics. So here are the statistics here, Jan of 2000 through February 3rd. out of 4,276 closes, okay, price would move and hit the upper 5-day band 29.3% of the time, hit the upper 10-day band 23, upper 15-day band about 23, the lower 5-day band 29.5, the lower 10-day band 29.2, the lower 15-day band 32% of the time. So this is the benchmark historical distribution of price Jan of 2000 through February 3rd of 2017. All right, now that's benchmark's been established, now we're going to look at the distribution after our condition. So here's our condition right now. What we're going to do is look at the distribution after the close. We're then going to ask ourselves, well, what's the distribution historically if price ascended above the high of the previous day, where you see those green diamonds? What if price went above the high? What was the distribution then? What if it went below the low? What was the distribution then? So we're going to measure 3 different distributions. That way, for Monday morning, going into this, you'll have some kind of a semblance of order here. So just based upon Friday's close, okay, the setup, the market condition I just showed you, 63 occurrences, okay, and these are non-consecutive, and what you'll see here is across the board lower numbers. From the close, lower numbers. Look at this. See that? Using statistical volatility. Using statistics. This is a picture of lower market volatility. Lower market volatility. And the numbers on the left, where we're looking at the upper 5, 10, and 15-day bands, these are a bit higher. Look at this. If price hit the upper 5-day band, normally 29.3, our market condition resulted in the upper 5-day band getting hit not even 16% of the time. Okay, so clearly it's failing to hit. Look at this different. This one 19, this one 14%. So for some big differences. So it's failing to hit the upper bands, and then it's also failing to hit the lower bands by not quite as much. So you would lean this thing a little bit bearish. It's failing to hit those. Now, does it mean it won't go up? Well, look, it did hit those upper bands, 14 to 19% of the time. Okay, so this is a picture of leaning slightly to the downside. Okay, let's look at if price exceeds the high. If price exceeds the high, lower market volatility across the board. If price exceeds the low, look at this now. Okay, the upper bands failed to get hit in substantial ways there. Look at that 5-day, only hit it 7%, not even 8% of the time. But there's only 13 here, so you gotta have to kind of discount that slightly. But it also, look at this, it did hit the lower bands more often. Again, a picture of slight bearishness here. Slight bearishness. Okay, so if the market does go down, you want to have a strategy where you're ready for it to go down, and you understand what your adjustment would be if it happens. Now, I also want to show you when we recast the bands using skew adjusted VIX, the bands are slightly farther away from the close because VIX is higher than statistical, and you could see then that the bands are getting struck less often on the baseline. They're not hitting it 23, 32% of the time. They're hitting it 14, 15% of the time up to 21. So the VIX adjusted bands, or the skew adjusted VIX bands, get hit less often. And then when we look at the measurements, then we could see similarly that the lower bands are getting struck relatively more often than the upper bands. So a picture of bearishness there, of slight bearishness. That's the kind of the way it's leaning here. Okay, here are the volatility levels, very low. Statistical, 20-day statistical, not even 8%. Skew adjusted VIX to the upside is at 9.1. Skew adjusted downside VIX at 12.8. Let's keep that number in mind, and let's go and take a look at a trading idea, which is a hedged bull put spread. Here, let me just click this off. Hedged bull put spread. If we're going to go bullish, and we expect that there's some possibility of it going down like what we just saw, you want to hedge it. And you would certainly want to consider doing that using an at-the-money bear put spread. So here we're selling premium a standard deviation away using our skew adjusted VIX number there to determine that standard deviation. So we bring some credit in. We use some of that money to buy a one-lot at-the-money bear put spread so that we still have a positive cash flow that is, a decent return. And so then we go and take a look, click, oh good grief, hit escape, there we go, escape, and then go here, there we go. There is the graphic analysis. What's nice here is no matter how far the market moves up, we can still make some decent money for roughly a month. If the market does go down, that hedge kicks in, it lifts the shoulder up such that we could make a good 3 times what it is we're trying to make on the upside. We can make 3 times on the downside at expiration, so long as it doesn't go a full standard deviation here. We'll be good. When you look at the price chart in the profit zone, it looks pretty good there. All we need for the market to do is to go up or wobble around. It can either wobble around and come down a little bit. We're still going to make money, so that's a real nice picture indeed. Folks, thanks for joining me. I'm Steve Lentz with Discover Options. We'll be back next weekend, same time, same channel. Bye-bye.